Welcome everyone to this session on taxes. I know taxes can be a bit drab. This is the summertime, and I want to give you guys some clarity on the institution of taxation, why it's important to understand this. And if your advisor or if your tax professional is not having these conversations with you and just presenting you with a refund, you need to find a new professional because they need to be asking you these questions. They need to be asking you significant questions because those questions determine what happens with your tax liability. And by the way, if they're not asking you these questions, it's time for you to get a new tax professional. A refund is not winning, it's your money, it's not a prize. Do not make the mistake of overpaying for a bonus. Now, this is what we're going to be discussing today. But on top of that, I want to get you some insight on who I actually am. My name is Kevin Thompson. I'm the founder CEO of 99 Capital Group, former Major League Baseball player turned financial professional, tax professional, retirement income certified professional as well. I work with mainly people that are 55 and older that are looking to retire immediately, looking for an income plan and looking to understand the complexities of Medicare, Medicaid, not Medicaid, but Medicare, a lot of the parts A, B, C, D, E, F, G, the whole alphabet soup. We also walk through Social Security planning, taxation, pension maximization, of course, investment assets as well, and all the whole kit and caboodle on that. So we focus in on that area, and then from high income professionals for younger individuals, we work with 1099 individuals or people making 250 or older or more. And those individuals allow us to build a savings plan, whether it be in the 401ks, investment assets, and possible child planning. And of course, we also work heavily in the estate planning process as well. We partner with other partners out there that allow us to bring certain estate planning tools to our network as well. So we offer a suite of things: tax planning, estate planning, financial planning, investment management, debt reduction. That is a whole host of financial planning aspects there. So again, certified financial planner, retirement income certified professional, and enrolled agent. And we've been featured in multiple different places: Newsweek, Yahoo Finance, News Nation, what have you, Financial Planning, U.S. News, Investment News. I mean, the list goes on and on. And we've been thankful for having these these media networks reach out to us. This has been a blessing. And host on 90 Innings podcast on the YouTube station, so check that out as well. But today, enough about me. We're here to talk about taxes and why it can feel confusing at times because, again, taxes feel overwhelming because most people only interact with them once a year. I don't believe in that. Again, I'm going to say this time and time again. If your tax professional is not asking for your 1040, what are they doing? How can you build a financial plan without knowing anything about a person's tax situation? You just can't do it. You're basically just throwing a product on them and telling them to go on their merry way. You're basically just throwing a solution on them and telling them to go on their merry way. A doctor takes an x-ray, a doctor looks at your vitals, and that 1040 is your vitals in regards to the overall financial plan. On top of that, the tax code changes regularly. Financial products evolve and retirement rules are consistently shifting, and many people receive advice from multiple professionals who aren't necessarily communicating with one another. The result is confusion. People often make decisions based on fear and headlines or assumptions instead of understanding how the rules actually work. And we've seen that with the current bill, the TCJA expansion, and all the different things that are coming out of congressional bodies that are changing the dynamics of the social of the retirement landscape, especially in regards to enhanced deductions, bonus depreciation, all the different things that are being put forth. So you got to be prepared for that. Another thing is, again, understanding tax preparation versus tax planning. There's a big difference. Tax prep, hey, give me your 1099s, give me your W-2s and your and I'll put them in the system and then give me a number and you have to pay it, right? That's tax prep. No, tax prep versus tax planning, entirely different. It's one of the biggest misconceptions I see is in the differentiation between these things. They think it's the same thing and it's not. Tax preparation, again, it's more like compliance. It's reporting that something that's already happened. Tax planning is a strategy. It's looking ahead and asking where the opportunities to improve the outcome are before year end, whether that's dollar cost averaging, tax loss harvesting, whether that's Roth conversions. These are the conversations we need to be having. Hey, should we put more into our HSA? Hey, should we put more into our IRA? Hey, what are the limitations on this said deduction? Should I be doing that? Will that get me more credits, access to credits? Those are the conversations we need to be having, especially in this time, especially if you're a retiree, because moving money in certain baskets. I'm going to take a distribution from my IRA. Well, we can do that, but what happens to the enhanced deduction when we do that? Now, again, the enhanced deduction, we'll get into that at a much later date, but taking a deduction, just to be clear, a deduction is money coming off of your taxable income, but it's based on your marginal rate. So for example, if you get $1,000 deduction and you're in a 24% tax bracket, that's $240 worth of less tax that you have to pay. So just FYI on that. So most people spend all of their time focused on filing taxes and very little time focused on the long-term planning. That's often when opportunities get missed. So the biggest tax misunderstanding is tax brackets. 100%. You've probably heard someone say, I don't want to raise my taxes because they'll push me into a higher tax bracket, right? I don't want to raise any more income. I don't want to have any capital gains because they'll push me into a higher tax bracket. That's one of the most common tax myths in America, right? Or I don't want to raise because it'll push me in a higher tax bracket. Those are the most common misconceptions. Our tax system is progressive. What it means is that income is taxed in layers, 10%, 12%, 22%. Moving into a higher tax bracket does not mean all of your income gets taxed at that higher rate. Remember, it's progressive. Only the income above that threshold is taxed at that rate. So, for example, if you've been between the 10 and 12% bracket your entire year and you have a dollar that puts you into the 22% bracket, well, that $1 is taxed at 22%, not the dollars below that. So that's what's called a progressive tax rate. Understanding that concept alone can help people make better decisions about their income, their bonuses, retirement distributions, and Roth conversions. Now, one thing I'll say about bonuses are often taxed at the highest marginal rate once you get them. So, for example, if your income is looked if my hey my income at the end of the year is going to be X, it should be around X. Most likely, your bonus is going to be taxed somewhere in the higher marginal rate all at once. So people say, oh, I feel like my bonus or that big chunk of money I got was taxed heavily. Well, most likely it is because it's taxed at those higher rates. So just be aware and be understanding of what that happens. Because when we talk about bonuses and all that stuff, that's money that falls on the tax letter at the last, basically at the end of the year. Even though you may get it in the beginning of the year, it still feels like it's coming in at the end of the year. Just like an IRA distribution. If I take an IRA distribution in day one, well, we tax it at 22% or whatever your marginal tax rate is because that money is stacked onto all the additional income at the end of the year. So we have to make sure that we tax it accordingly. So marginal rate versus effective rate. This is where marginal and effective rate tax rates become important. Your marginal rate is the tax applied to the next dollar you earn. Your effective rate is what you actually paid across all of your income. So just to put it into context, if I am at the 24% rate, that next dollar is going to get taxed at 24%. But my effective tax, which means like what was my what did I effectively pay across all these income ladders? That's what you're actually paying. Those two numbers are often very different. Many people hear, "Oh, I'm in the 22% bracket or 24% bracket," and assume every dollar is taxed there. It is not. That's simply not how the system works. You have a progressive tax system. I'm going to say it time and time and again. And if You are working with a financial advisor that's not asking these questions, that's not answering these questions, that doesn't even know what your effective tax rate is, but is making investment decisions on your behalf. It's time to make a change. So let's talk about why refunds can be misleading. I've had multiple conversations around this because if you receive a large refund, it only can mean that you withheld too much throughout the year. You basically gave the government a tax-free loan. Now, nothing inherently wrong with that. 'Cause I know people fear, oh, I don't want to have that $4,000 to $5,000 tax hickey at the end of the year, and I get it. I get it, and it's very difficult to get it down to zero. It is very, and nobody likes owing the government anything. Now, some people intentionally over withhold because they like the discipline of getting a lump sum back. That's perfectly fine. The key is understanding what is actually happening rather than assuming a bigger refund is a better tax outcome because guess what? It's a zero interest loan to the government. They're borrowing your money, and you see how good they are with money at this present time. They have a $40 trillion debt, so deficit. So it's understandably we don't want to give them any more money than they need. We can do better with our own money, and it's time for us to do a better job in putting those dollars away as best we can. So sorry. So the retirement, navigating unforeseen tax challenges, while your tax burden might not decrease over in retirement. Most people often believe that when they get to retirement, they're going to be in a lower tax bracket. Well, that's fine if you believe that. Now, there's multiple reasons why that might not be the case. I have a handful of clients actually that yes, technically they are in a lower tax environment. However, like I said, the progressive tax system from a W-2 working space. Think about the things you no longer have to pay payroll taxes because again, you're in retirement, so it's payroll taxes at 15.3% or whatever that half that percent, 7.65% that you were paying no longer is there. There's a lot of things that you no longer have access to. Now, sometimes it's true that you're paying lower taxes, but it's not always the case. Retirement introduces new tax issues. Social Security may become taxable, right? Uh, Up to 85% can be taxable. Medicare premiums can increase because of income, which is called IRMA. Capital gains, pensions, and inherited accounts all create additional complexities. Retirement isn't just about replacing income, it's about managing taxes on that income as efficiently as possible. I will say that there's often some opportunities for people that are single. We can do some capital gains harvesting where we don't have to pay taxes on that. Also, the widow's penalty is real. If one of you, if you, so, and here's how I like to describe it. You have two individuals both making say $75,000 of income. They had their IRAs, both had nice little IRAs, both had their social securities. They had a combined $150,000 of income, right? Now, all that $150,000 of income is not completely taxable because the majority of that is Social Security. Maybe 80 to $90,000 of that is Social Security. That's fine. But the additional amount, which has come from IRAs, is taxable. But what happens here is that let's just say hypothetically one of the individuals passes away, that money goes away, the Social Security money goes away. The other individual may have a lower income, lower Social Security amount, so they step up. That's beautiful. That's fine. But what doesn't go away is the IRA distributions. The RMDs are kicking in. That pushes you up into a higher tax environment because now you have the compressed tax rates as a single individual. Yes, your tax rates are no longer married filing jointly, it's single. And your tax rates come down, your income actually stays up, and now you have what we call the widow's penalty. And a surviving spouse may be in a much higher tax environment, and now that gets you exposed to IRMA taxes, that gets you exposed to higher marginal rates, and effectively less than stellar outcome. So that's why we talk about Roth conversions early, paying the cost there, especially if legacy is something that we need to discuss. Also, your tax return tells a story. Income sources, planning gaps, investment behavior, some inefficiencies around the taxes, retirement risk, future opportunities. The 1040 tells me everything I need to know. What's going on, where you're housing assets, and sometimes it tells me things I don't need to know, which I've had discussions with certain tax individuals about certain improprieties I may have seen. But most people just sign their returns and immediately move on. But your tax return continues to contain a tremendous amount of information. It shows income, how much you paid in taxes, what deductions you received, what credits you received, what planning opportunities exist. A return can reveal problems long before they become major issues. It can also identify opportunities that may have significant money in the future. I have seen, especially in regards to combating major issues, where individuals file their taxes, but then you look back and like, hey, a couple years ago, I see this. I don't see this now. What's the issue here? We may have to go back and amend. And of course, we did some amendments, and yeah, there were some gaps and some issues there. So it's important to always get the 1040. I will say it time and time again. Get the 1040. If your advisor's not asking for it, I say get into advisor. Now, the common tax mistakes we see after reviewing hundreds of returns, certain mistakes show up repeatedly. Income withholding is income incorrect withholding is common. Missing quarterly payments is absolutely common. Poor basis tracking, absolutely common. I also see people with Roth conversion opportunities fail to coordinate beneficiary designations decisions and overlook how Social Security timing impacts taxes. Many of these mistakes aren't caused by bad intentions. They're created by lack of coordination and planning. So getting your individuals together and having these conversations is key, especially if you have a CPA. They need to be working with you on your bookkeeping if you are a business owner. And if you are a business owner, making sure you have books and records on file with it, whether that be through Quicken or Intuit or whomever, making sure those books are up and ready. I've seen so many 1099 individuals that are just not coordinated, and it's very difficult processing, but we get things cleaned up pretty quickly. Also, again, incorrect withholding, uh, especially from last year, withholdings were incorrectly done because the July 4th big beautiful bill. Once that passed through, the withholdings had to be updated and never were, and then people got larger than expected refunds. And oh well, is it really a larger than expected refund? No, it's just your money back. So we have to understand how that actually works. So and on average, the refunds were roughly the same as the previous year. So there really was no real difference there when I looked at a lot of the tax refunds there. But I also saw that Social Security in some cases, or most cases, was actually taxed, especially for many of my clients. The W-2 versus 1099 reality. The W-2, the 1099 is a shock, really, because a lot of people don't understand that there's quarterly tax payments. Self-employed workers are directly responsible for estimated income taxes throughout the year. I don't know how many, I'm going to say that time and time again. W-2 employees, they take their withholdings are done automatically, right? They're all throughout the year. Self-employment taxes, you are responsible for the additional self-employment tax as a 1099 individual. That's a shock. I know the 15.3%, that's all on you. But again, there's ways to have that conversation. There's ways around it. We need to have a conversation about that. Those are longer conversations based on how your business is structured. Cash flow pressure. You need to consistently set aside funds for tax obligations without automatic deductions is a shock and potential underpayment penalties. The risk of penalties of estimated taxes, if they're not paid accurately or correctly on time, is very, 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 very key. So being self-employed creates opportunities, but it also requires discipline. You have to think like a business owner and prepare for taxes throughout the year instead of reacting at filing time. The real purpose of tax planning, good tax planning is about more than savings, more than taxes. It's about cash flow, coordination, efficiency, long-term strategies, avoiding surprises, and retirement sustainability. Many people think planning is simply about just paying less tax. That's not the case. That's only a part of the equation. Good tax planning, like I said, cash flow. The goal isn't necessarily to pay the least amount of tax in this year. The goal is often to pay the least amount of tax over a lifetime. Now we're going to look at the tax return, how it's your mirror. I'm going to say this time and time again. The tax return is our x-ray. It reflects your decisions, your habits, your income structure. Your tax return reflects all the decisions you've made throughout the year. The return itself isn't the goal. The goal is understanding the story behind the numbers and using that information to make better decisions moving forward. Remember, your tax return is your scorecard. The question is whether you're taking the time to study it. If they're not asking for your tax return, ask them, what are you doing for me? If you don't know what my tax structure looks like, how are you doing financial planning? How are you doing conducting investment management? How are you even concerning my legacy benefits? Do you even know anything about my legacy benefit, my legacy concerns? Do you even want to know about if my mother's gonna make if she passes away, if there's money gonna be inherited? These are the things that need to be asked when we talk about full financial planning, not just runoff investment management or sales. That's the main difference. Call to action. If you're approaching retirement, already retired, running a business, or simply trying to better understand your tax situation, don't wait until season is here. Don't wait until the filing season is around the corner. Don't wait till you have a tax hickey on your shoulder. It's important because the best opportunities often happen before December 31st, not after. And now at Capital, we help discuss with clients. We coordinate tax planning, retirement planning, investment management, and estate planning to help decisions. And we want all this stuff to basically just to work together and not against one another. Because I understand that if you have multiple individuals, CPA, investment manager, insurance, all these different people working on your team, they may have different goals and different ideas, but it's good to have that quarterback in the room that knows exactly what's going on in each of these realms so they can help you make that decision, the best decision for you. And quite frankly, they need to know what's going on because the reality is the fiduciary liability lies on them. If you like a second set of eyes on some of your situations, we'd be happy to have a conversation. We are here to help. We are here to engage. We're here to empower. As always, stay humble, stay safe. We'll see you again next time.